I'm going to talk a little bit more about SoFi Technologies reported earnings this week. We saw the stock price skyrocketed. You go back and look a little ways and it's up 90% from the low point over the past year. A lot of investors are thinking, maybe I missed the opportunity to invest in SoFi stock. I'm going to break down why investors might not have missed the opportunity after all and why the future looks really good for SoFi. I'm Jason Hall. This is Investing Unscripted. And this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. Go to fool.com/unscripted. Motley Fool is going to give you its 10 best stocks to buy right now. Okay, I'm recording this video the day of earnings. The afternoon earnings came out, and right now the stock's up about 20%. That's a pretty good year for most investors' portfolios. And if you go back to May 15th, 2023, that was right after the last of the three big bank failures in 2023 occurred when First Republic was taken over by the FDIC. It's up 91% since then. You see, it's been up even more at different times. That is one heck of a run. So what's happened that's driven the stock up? I'm going to talk about the earnings a little bit, share a little bit of insight there. But I do just want to remind everybody that last year was a tough year for banks. Number one, we saw a mini banking crisis. In March, two big banks were taken over by the FDIC. And in May, a third big bank was taken over by the FDIC. This was the first bank failure period that we've seen like that, going back to the global financial crisis, really 15 years before when it started and started heading towards the big banking crisis. To see three banks as big as the ones that failed happen in a single year was a big deal. And it sent most bank stocks down. Second, higher interest rates also hit a lot of banks. Higher interest rates generally are good for banks, but when they rise slowly, when interest rates skyrocket really quickly, it makes it really hard on banks because depositors demand higher yields. And well, the yields that you're earning on your lending assets, your loans, might take longer before you're able to raise those as quickly as you're having to raise rates that you're paying out to your depositors. So banks kind of got squeezed a little bit last year. Put all that together, and we've moved beyond that. Economy's healthy. Consumers continue to spend. Seems like most people have adjusted to higher rates. And for banks like SoFi, the way that it's structured, it's happy to pay higher yields out to its depositors because now that means it lowers its borrowing costs versus having to use warehouse facilities. It's even paying the high yields that it pays. It's been a big net beneficiary of higher interest rates, bringing more deposits to it. We'll talk about that when we take a look at its results and how much it's grown its customer base over the past year. Its net interest margin, which is the yield that it earns on lending assets versus what it pays out in borrowing costs and funding costs, actually just broke 6% net interest margin. So things are really good for SoFi. That's a big part of the reason that the stock price has gone up. Let's take a look at the presentation. Now, I want to highlight a few things that are the big reasons why, beyond the stuff we've already talked about, from a business perspective, they're the big reasons SoFi stock's doing so well. With banks, it starts with customers, and there's no denying that SoFi has seen an incredible run of growth. Still growing at 40% plus rate in terms of new members, over 7.5 million members, added almost 600,000 members in the fourth quarter. Just a great period of growth. You look at products, so that's loans, deposit accounts, trading accounts, other financial services and products that they offer. Added 695,000 new products. That's over 11 million. So it's just under 1.5 products per member. Ideally, over time, we want to see new products grow faster than member growth, but both are growing so quickly right now. Be a little bit too picky to really fuss about that particular thing. Lending products, it's growing 24%. So it's growing slower than their financial services products, but that's fine. This is a really good growth rate for a lending portfolio. If you see a lender out there that's growing 40, 50% a year, they're probably taking on far more risk than you want to see them taking on. So financial services products, this is two things that this does for SoFi. Number one, you think about their trading accounts, other financial services products like that. Those are revenue generators, they're earnings generators. Deposit accounts, this is a funding generator. It's an expense. They have to pay yield to those depositors, but they get the cash, and the cash is the asset that then they can lend out to fuel their lending business. This is really important for two reasons: generating those fees-based revenue for their financial services, generating the cash that they can then use to lend out to drive their lending business. As a result, revenue continues to grow at a very high rate, more than 30% in the quarter. The key is they're saying that revenue growth is going to continue. They're saying like mid-20s% compounded between now and 2026. They're expecting continued really high rates of revenue growth. So we talked about earning money in the fourth quarter. They earned a couple cents a quarter in the quarter. If you look at the full year for 2024, by the end of the year, they're expecting on a GAAP basis, solidly profitable. It doesn't seem like much when it's only 7 or 8 cents, but if you think about it on a full dollars basis, earning $100 million, you're a profitable business. And that is a great, solid, strong position for SoFi to be in. Okay, so there you are. 8 cents a share, shares around $9 a share. You know what that means on a price to earnings basis? This is an extremely expensive stock, right? Feels like maybe you did miss the opportunity if you're just thinking about it from a valuation, pure value investor sort of mentality. I think that's the wrong approach to take with SoFi. Yeah, it's profitable now, but it's still growing. Like we talked about those growth rates with member acquisition, growing its lending business at 20 to 25%, very high rates. That can really generate a ton of earnings power over time. So I think instead of looking at today's price to earnings ratio, they've given us a number, a ballpark number that we can use to start trying to figure out, is today's price for SoFi stock worth it to own the business, maybe over the next 5+ years? Let's take a look at that number. So let's jump over to the press release and take a look under the guidance and outlook. This is something I talked about briefly in a prior video that we did, but this video, I'm going to talk through it and I really want to highlight it and focus on it based on what it means for buying shares of the company today, thinking about present value for future income, what you're getting. So again, we know they're looking at earning 8 cents a share for 2024. Looking beyond 2024, we talked about it before, 20 to 25% growth on a compounded annual basis through 2026. We don't know what's going to happen with the macro environment. It's a bank. Banks are very heavily leveraged to the macro environment. So if things change, all bets are off. But again, taking on that risk, what they're expecting is this number right here. They're expecting, you look at all of their growth rates, their expectations, they're expecting to earn 55 to 80 cents in GAAP earnings per share in 2026. Okay, what does 55 to 80 cents in GAAP earnings per share equate to? The stock price, round figures, call it $9 a share. $9.06 is the actual price when I'm doing this. Your mileage may vary depending on when you watch this video, whether the market's open or not, and what the stock price happens to be. We know it can be super duper volatile, but we're going to use that $9 a share because that's the number that we're dealing with right now. Now, again, they're saying 55 to 80 cents in GAAP earnings per share in 2026. So what does that mean in terms of a valuation? Well, let's just use the old price to earnings ratio. You've got a $9 stock price, 55 cents per share in earnings. That's about 16.4 times the bottom end of that range of valuation. So let's say the 80 cents, the higher end of the valuation of the earnings range, that's 2.5 times 2026 earnings. To me, frankly, that sounds pretty cheap. You're able to buy SoFi stock today. You pay $9 a share. Again, your mileage may vary. You may pay a little more. You may pay a little bit less. Thinking about it directionally, being able to pay a low to mid-teens price to earnings ratio for an increasingly profitable bank that's still growing its revenues at 20 to 25%, I think is a reasonable valuation. Take SoFi stock at this price. You own it for 5 years. You own it for 10 years. We're going to go through periods where, like every bank, SoFi stock's probably going to take a hit if the macro environment doesn't get good. I think management's going to run the business pretty well through that, and they're not going to take on too much risk. They're going to stay well capitalized. If that happens, I think even this price, even with the run of the stock price that we've had over the past year, especially from those lows in May, I don't think investors have missed the opportunity. Frankly, SoFi is a stock that is still near the top of my list of watch list stocks to add to my existing position. But again, I'm intending to hold this bank for many years to come, not making a trade, not looking to sell before macro conditions get bad, looking to hold through those macro conditions as long as management continues to run the bank so well. I don't think investors have missed the opportunity. You just have to be willing to ride the roller coaster of volatility. Long term, this is a bank that I think is going to continue to take market share and grow. Investors that pay this price for the stock, hold it for the long term, I think are going to be super glad they did.